So we mentioned the price action today. You're eyeing 136 now?
Yes.
Is that December 19 or December 2020?
Yeah, we have a 12-month outlook, and we've raised our price target now to $136. Certainly the results today were extremely strong, both on the top line, as already mentioned, right? Strong positive traffic, also with 31% growth in digital sales. But even more impressive was the EBIT gain year over year of 22% from an operating income standpoint. And they're doing this through lower fulfillment costs. They're also really improving the category mix, and they're taking a lot of share in discretionary categories. And we see a ton of catalysts ahead as we think about the newly rolled out Target Circle membership program, the Good and Gather on the food side, and we think there's a strong free cash flow profile here as well that's not only leading to remodeled stores today, but will buy back a ton of shares in the outer years.
Jerry, I'm wondering, when you think about Target, and they talk a lot about using everything together, stores and online, fulfilling from stores, lowering the cost by 40% or 90% if a customer actually comes in and picks it up themselves. But a lot of retailers offer this now, this buy online, pick up in store. Why is it working so well for Target and not as well for others? What's the difference?
Well, they're doing a great job, but keep in mind that 92.5% of Target sales are still store-based. You can see that in what they're reporting today. So that's what's remarkable, is that in this internet era, their store comp was 2.8%. That would have been good before the internet. That was a good number. And then they have the 31% internet growth on top of that. So they're doing a great job merging the two. They're going to keep growing. The 4.5% out of Target for a total comp, that's like what we used to do in the old days when the economy was just on fire. And by the way, people ask about the health of the consumer. One of the best signs I see that the consumer is very healthy is that in good times, Target beats Walmart. In bad times, Walmart beats Target. We've been saying that for like 3 decades. So Target did a 4.5 comp. Walmart did a 3.2% comp. Both still good, but Target better. The consumer is very, very strong.
But Jerry,
so in good times, they win.
I just want to stop you 1 second. What's the lesson here in terms of what we learned that Target has done right? I mean, we've been sitting in this desk with you for years now talking about all the pressures retailers are under, particularly mall-based retailers, but all across the board. These guys have done something over the last couple of years that's changed the paradigm, right?
Let me go through it. So first of all, they're value-based. And as we've discussed right here at this desk, the value retailers are doing great. It's not just Target, it's Target,
but not
Walmart.
all of them. Kohl's isn't doing so well on their value-based.
I don't agree with you about Kohl's. Kohl's is a department store. Who could be worse? An apparel-focused department store. At least they're off the mall sometimes not. But look, they are apparel-focused. You said it yourself. Apparel's been very weak, highly deflationary. Target's the first good apparel number I've seen in ages. Even Walmart said their apparel was poor. Target has always stood for apparel. They have a differentiated offering. All it's proving to me is that the customer is trading down to apparel, is trading at lower price points, and Kohl is stuck in the middle. And it's wonderful as Kohl's management is. They're a department store that's apparel-focused. And beyond all of that, at the end of the day, as their business shifts to the internet, unlike many of these players, their economics degrade mightily. They have a very low average ticket.
All right,
it's
back
horrible
to
fulfill
back to
it.
the lessons on Target, though, because you're making your points. What were the other ones?
Okay, so Target is a differentiated player. To succeed in this area, you have to have product nobody else has. Target's always stood for this, and there's a continued focus on the own label. You heard Brian talking about that today. We've been talking about that for decades at Target. There are products that you can't buy anywhere else, so you can't go somewhere else on the internet and buy it. You have to go to Target in order to get it. And they've done so differentiated product, value-based player, and they've done a great job on the internet. They've said, the heck with the old, traditional Amazonian model, not Amazon's current model, but the old model of the direct model of shipping from a DC often, Timbuktu to your home. They're doing it from the stores, and that drives additional traffic for store pickup, for driving up to the store. They're leveraging what they own in order to succeed. A lot of retailers are watching as this takes place, but none of them have that combination of a fantastic store environment with positive comps and internet growth. By the way, a lot of these players, when they do their comp, it's a negative store number. Negative, along with a positive internet, which is destroying their economics. Target is both up.
Why hasn't the Kohl's partnership, the pickup partnership, worked? Or is it working and we just don't see it yet?
Look, I think it's too early to tell for Kohl's Amazon. We would actually argue that it is absolutely driving traffic
better
into
than it would have been
box.
otherwise.
Certainly better than it would have been otherwise. But ultimately, we think that what it comes down to in terms of differentiation between Target and a Kohl's is really selling and focused on national brands, all right, and what I think are very distinct value-based, proprietary labels, and we really give Target a lot of credit for the way they've started from scratch and put out a Cat and Jack, which is now like the largest children's, brand in the country. And so that, along with what we really emphasize, is same-day fulfillment options. And I think that, again, this is what Amazon can't do. And I think it's really underappreciated, the acquisition that Target made of Shipt. All right, and when you add that to the way that they've changed their supply chain and the back of store to be able to do that curbside pickup, I think the customer has found a convenience factor that's almost like a better mousetrap. And ultimately, I think the customer is continuing to come back because of that appreciation of that customer experience.